If you have been hearing the words crypto ETF everywhere lately and you have been nodding along pretending you understand what it means, this video is for you. Because the crypto ETF story is one of the most important financial developments of the last 2 years, and most people who own crypto do not actually understand what an ETF is, why it matters, who it is for, and why the approval of these products has fundamentally changed what crypto is as an asset class forever. By the end of this video, you are going to understand all of it, clearly, without jargon, without assumptions about what you already know, from the very beginning. Let us start with the basics. What is an ETF? ETF stands for Exchange Traded Fund, and the easiest way to understand it is to compare it to something you probably already know. Imagine you want to invest in gold. You have two options. Option 1 is to go buy actual physical gold, a gold bar. You store it somewhere, you insure it, you worry about it, and when you want to sell it, you have to find a buyer, verify the gold is real, transfer it physically, and complete the transaction. That is a lot of work. Option 2 is to buy shares in a gold ETF, a fund that owns actual physical gold on your behalf. You buy shares in that fund through your regular brokerage account, the same way you would buy shares in Apple or Microsoft. The fund handles all the storage, the insurance, the custody, and the security. You just own a piece of it and can buy or sell your shares anytime the stock market is open with a single click. A crypto ETF works exactly the same way. Instead of buying Bitcoin directly, setting up a crypto wallet, managing your private keys, worrying about exchange security, and figuring out how to store your assets safely, you buy shares in a fund that owns actual Bitcoin on your behalf. That fund trades on a regular stock exchange. You buy it through your regular brokerage account. Your regular financial advisor can recommend it. Your retirement account can hold it. The complexity of dealing with crypto directly is completely removed. You just own exposure to the price of the underlying asset wrapped in a familiar, regulated, legally protected investment structure that the traditional financial system already understands. Now, here's why that matters so much more than it might sound. For most of the last decade, crypto was something you could only access if you were willing to go through the direct process. You had to create an account on a crypto exchange. You had to go through identity verification. You had to fund the account, navigate the interface, buy the coin, and then decide whether to leave it on the exchange or move it to a personal wallet. If you made a mistake and sent your crypto to the wrong address, it was gone forever. If the exchange got hacked or collapsed like FTX did in 2022, your money could disappear overnight. For most ordinary investors, that risk and complexity was simply too high. For most financial advisors, recommending a product with those risks to their clients was legally and ethically impossible. For most retirement account managers, including crypto in a pension fund or 401k was simply not permitted. That is the wall that crypto ETFs demolished. When the SEC approved the first spot Bitcoin ETFs in January 2024, they did not just create a new investment product, they created a bridge, a regulated, compliant, insured, legally familiar bridge between the traditional financial system and the crypto asset class. And once that bridge existed, the capital that had been sitting on the sidelines waiting for it started crossing. The numbers that came in were unlike anything the ETF industry had ever seen before. BlackRock's iShares Bitcoin Trust, ticker IBIT, became the fastest-growing exchange-traded product in history. Spot Bitcoin ETFs attracted $57.7 billion in net inflows in their first year of trading. By the first quarter of 2026, combined assets under management across all U.S. spot Bitcoin ETFs reached approximately $128 billion. BlackRock's IBIT alone commanded over 45% of that total, with average daily trading volume exceeding $3.2 billion. To put that in context, there are entire countries whose annual economic output is smaller than the daily trading volume of a single Bitcoin ETF. But Bitcoin was just the beginning, because once the regulatory framework was established and the market proved that institutional demand for crypto ETFs was real and enormous, the door opened for every other major digital asset. Ethereum spot ETFs received SEC approval in May 2024 and began trading in July 2024. Then, in September 2025, the SEC approved generic listing standards that cut the approval timeline for new crypto ETFs from up to 240 days down to as little as 75 days. That single regulatory change unleashed a wave of new products that landed in the final months of 2025. Solana ETFs, XRP ETFs, Dogecoin ETFs, Litecoin ETFs, Hedera ETFs, Chainlink ETFs, a Cardano ETF in development, multi-asset crypto index ETFs, staking-enabled ETFs that pay yield while you hold them. The landscape went from one approved crypto ETF in January 2024 to an entire asset class of regulated investment products available through standard brokerage accounts by the end of 2025. Let me walk you through the most important ones specifically, because this is where the story gets genuinely exciting for anyone who holds or is thinking about holding any of these assets. The XRP ETF launched in November 2025, led by Canary Capital's product on NASDAQ. On day one alone, it pulled in nearly $250 million, the largest single-day debut of any crypto ETF that year. XRP became the second fastest crypto ETF ever to reach $1 billion in assets under management, after Bitcoin. 7 spot XRP ETFs now trade in the US from major issuers including Grayscale, Bitwise, Franklin Templeton, and 21 Shares. Grayscale's XRP Trust debuted on the NYSE in November 2025. Franklin Templeton's XRP-Z ETF pulled in $225 million in its first 2 months of trading alone. The HBAR ETF launched in late 2025 under ticker HBR, becoming the first U.S. spot Hedera ETF and giving institutional investors their first regulated pathway into the Hedera network. This matters enormously for HBAR holders because institutional asset managers, registered investment advisors, and family offices have a fiduciary duty to their clients that requires them to use regulated, compliant custody solutions. Before the ETF existed, most of those investors simply could not hold HBAR in their client accounts without significant legal exposure. The ETF removed that barrier entirely. Now, a financial advisor managing $100 million family office portfolio can allocate to HBAR the same way they allocate to any other asset in their investment universe. The Algorand and Stellar ETF landscape is still developing as of this video, but the trajectory is clear. The SEC's generic listing standards framework means any asset with sufficient market maturity, liquidity, and regulatory standing can move through the approval process in a fraction of the time it took earlier applicants. And with Algo just receiving joint SEC-CFTC commodity classification in March and April 2026, and Stellar continuing to build its institutional infrastructure through Franklin Templeton's tokenized treasury fund and U.S. Bancorp's stablecoin pilot, both assets are moving toward the regulatory standing that makes ETF approval not a matter of if, but when. Now let me explain the different types of crypto ETFs because they are not all the same, and understanding the difference matters. The first type is a spot ETF. This is the one that most people mean when they say crypto ETF. A spot ETF directly holds the actual underlying cryptocurrency in custody. When you buy shares in a spot Bitcoin ETF, the fund manager goes out and buys actual Bitcoin and holds it in a regulated custody account on your behalf. Your shares represent a proportional ownership stake in those real Bitcoin holdings. The price of your shares tracks the spot price of Bitcoin almost exactly because the fund holds actual Bitcoin. Spot ETFs are the purest form of crypto exposure through traditional financial infrastructure, and they are what most of the new products launched in 2024 and 2025. The second type is a futures ETF. This type does not hold actual cryptocurrency. Instead, it holds futures contracts, which are agreements to buy or sell the cryptocurrency at a specific price on a specific future date. Futures ETFs were approved by the SEC before spot ETFs, and the first Bitcoin futures ETF launched back in October 2021. The problem with futures ETFs is that they can track the actual crypto price less accurately over time due to something called roll costs, which are fees incurred when futures contracts expire and need to be replaced with new ones. For most long-term investors, spot ETFs are a significantly better product than futures ETFs because they hold the actual asset and track the price more faithfully. The third type is a staking ETF. This is a newer development that some issuers have been building into their products. A staking ETF not only holds the actual underlying cryptocurrency, it also participates in the proof-of-stake network's staking mechanism, earning yield on the held assets and distributing those rewards to shareholders. This means you get both price exposure and passive yield from your ETF shares, similar to a dividend-paying stock. Staking-enabled products have been a major development for assets like Ethereum and Solana, where staking yields are meaningful.
The fourth type is a multi-asset or index ETF. Rather than tracking a single cryptocurrency, these funds hold a basket of digital assets weighted by market capitalization or some other rules-based methodology. Franklin Templeton's Crypto Index ETF, for example, allocates approximately 77% to Bitcoin, with the remainder spread across other major digital assets. Multi-asset ETFs give investors diversified exposure to the crypto market without needing to choose individual coins, similar to how an S&P 500 index fund gives investors diversified exposure to the US stock market without needing to pick individual stocks. Now, here is the question most beginners ask at this point. If I can just buy crypto directly on an exchange, why would I ever buy a crypto ETF instead? The honest answer is that it depends entirely on your situation. There are real advantages to ETFs, and there are real advantages to direct ownership, and every advanced crypto holder should understand both sides clearly. The advantages of ETFs are significant. They are accessible through accounts you already have. If you have a brokerage account, an IRA, a 401k where crypto is permitted, you can buy a crypto ETF right now without opening a new account, without learning what wallets work, and without any of the technical complexity of direct crypto ownership. They are regulated and legally protected. ETF assets are held in regulated custody under legal frameworks that protect investors in ways that crypto exchanges often do not. They can be held inside tax-advantaged accounts. This is one of the most powerful advantages. Holding a crypto ETF inside a Roth IRA means your gains grow completely tax-free. Holding direct crypto outside a tax-advantaged account means you owe capital gains tax every time you sell. And they are familiar. Financial advisors can recommend them, pension funds can hold them, retirement accounts can include them. The entire infrastructure of traditional wealth management can engage with crypto through ETFs in a way that direct crypto ownership simply does not support. The disadvantages of ETFs are also real. You pay a management fee, typically between 0.2 and 1% annually to the ETF issuer for managing the product. You do not actually own the underlying crypto. If the ETF issuer faces problems, your exposure depends on the regulatory protections around the fund structure rather than direct self-custody. You cannot use your ETF shares to participate in DeFi, staking outside the ETF wrapper, or any on-chain activity. And perhaps most importantly for advanced crypto holders, you cannot move your ETF shares off exchange into self-custody because you do not actually own the coins. You own shares in a fund that owns the coins. For complete beginners who want crypto exposure without complexity, ETFs are often the simplest, safest, and most accessible starting point. For experienced holders who want maximum flexibility, self-custody, and the ability to use their assets across the full range of on-chain capabilities, direct ownership remains the more powerful option. Most serious crypto wealth builders eventually understand both structures and use them strategically for different purposes. Here is the big picture that ties all of this together. The approval of crypto ETFs is not just a product launch, it's a reclassification event. Every time a new crypto ETF receives SEC approval, the agency is implicitly confirming that the underlying asset has met the standards of market maturity, liquidity, and regulatory standing required for a regulated investment product. It's the financial system saying, yes, this asset is real enough, mature enough, and legitimate enough to sit inside the same investment infrastructure as gold, stocks, and bonds. And once the financial system says that, it doesn't take it back. The infrastructure gets built around it. Products multiply, advisors learn to recommend it, retirement accounts gain access to it, and the demand profile of the asset changes permanently. Spot Bitcoin ETFs generated $57.7 billion in net inflows in their first year. XRP ETFs crossed $1.3 billion in their first 50 days. The cumulative trading volume of all U.S. spot crypto ETFs surpassed $2 trillion by early 2026, doubling in half the time it took to reach $1 trillion. This is not a niche product serving a small corner of the market. This is the largest capital access expansion in the history of the crypto asset class, happening right now in real time, with new products launching and new institutional capital entering on a timeline that compresses faster with each approval. If you hold any of these assets and you've been waiting to understand what the ETF story means for you specifically, the answer is this. It means that the pool of buyers for what you already hold just got dramatically larger. It means that capital that could not reach your asset before can now reach it through a channel that didn't exist 2 years ago. And it means that every major financial institution, every retirement account manager, every registered investment advisor in America now has a regulated, compliant, legally familiar pathway to the assets you've been holding before any of them were paying attention. That's what a crypto ETF is, and now you know exactly why it matters. If this breakdown gave you clarity you weren't finding anywhere else, hit the like button right now. It costs you nothing and it tells me directly to keep building foundational content like this that actually explains things from the ground up instead of assuming you already know everything. Subscribe if you want crypto education that meets you exactly where you are and never makes you feel lost. Every video on this channel is built to make you more capable and more informed, whether you're just starting out or have been holding for years. Drop your answer in the comments right now. Before watching this video, did you actually understand what a crypto ETF was, or were you one of the people nodding along? Be honest. And if there's a specific ETF or a specific part of this explanation you want me to go deeper on in a future video, tell me below. Your questions shape what gets made next. And if you know someone who keeps hearing the words crypto ETF on the news and has no idea what it actually means, send them this video today. Because understanding this is not optional anymore. It's table stakes for anyone who takes their financial future seriously. Now you know. Share it like you mean it.